Hey there. So, if you're getting serious about retirement planning, you've probably heard this acronym thrown around: RMD, Required Minimum Distribution. It sounds complicated, right? Especially when you start mixing in annuities. But I promise you, the answer to whether your annuity has an RMD is actually way simpler than you think. It really just boils down to one single detail. And by the time we're done here, you are going to get it completely.
So, here's our game plan. We'll kick things off by making sure we're all on the same page about what an RMD even is. Then we'll get to the most important part, the one difference between annuities that changes everything. From there, we'll get into the nitty-gritty of the rules and dates, check out a really smart strategy for handling RMDs, and then wrap it all up with what this means for your plan. All right, let's dive right in. Before we even touch on annuities, we've got to nail down this whole RMD thing. You hear it all the time, but what does it actually mean for your money? Think of it like this. For years, maybe decades, you've had money growing in your IRA or 401k, and the beauty is you haven't paid a dime of tax on all that growth. Well, an RMD is basically the IRS knocking on your door and saying, okay, the party's been great, but it's time to pay the piper. They require you to take a minimum amount out each year so that they can finally tax it. Okay, now lean in for this part, because this is the absolute key to this whole explainer. The answer to our big question, do annuities have RMDs? It all comes down to this one simple distinction. This is it. This is the whole shebang right here. It's all about which piggy bank you use to buy your annuity. Did you use money from your pre-tax piggy bank? Funds from an IRA or 401k that the IRS hasn't touched yet? Or did you use money from your after-tax piggy bank, like from a regular savings account where you've already paid taxes? That one answer changes everything. And right here on this slide, you can see the official names for our two piggy banks. On the left, we have a qualified annuity. That's the one you buy with pre-tax money. And since the IRS is still waiting for its cut, you guessed it, RMDs are a yes. But over on the right, you have the non-qualified annuity. This is bought with after-tax money. The tax is already taken care of, so no RMDs. Simple as that. So now that we've got that key distinction down, pre-tax versus after-tax, let's take a look at how this all plays out in the real world. So here's the crucial takeaway. It's not the annuity product itself that has RMDs. It's all about the tax status of the cash you use to buy it. The annuity is really just a container. What the IRS really cares about is what kind of money you put inside it. This chart just lays it out perfectly. A qualified annuity, funded with pre-tax dollars from an IRA, yes, it's absolutely subject to RMDs. A non-qualified annuity funded with your after-tax savings? Nope, no RMDs for you. And then notice that special case at the bottom, a Roth IRA annuity. Just like a non-qualified, it's funded with after-tax money. So for you, the original owner, there are no RMDs during your lifetime. Okay, so we get the difference now between qualified and non-qualified. Fantastic. Now let's dig into the specifics, the key dates and numbers you absolutely have to know. As of right now, the magic number is 73. That's the age when the RMD clock officially starts ticking on your qualified accounts. Now, keep in the back of your mind that this age has been changing thanks to new laws, and it's actually set to go up again in the future. But for today, the number to remember is 73. And this is why we're talking about all this. This is why it's so critical to get it right. If you miss your RMD, or you just don't take out enough, the penalty is a whopping 25% of the amount you were supposed to withdraw. That is a massive penalty, and it's completely avoidable if you know the rules. Now, let's talk deadlines. The IRS actually cuts you a little slack for your very first RMD. You can delay taking it until April 1st of the year after you turn 73. But, and this is a big but, if you do that, you'll end up having to take 2 RMDs in that same year, your first and your second. Ouch. For every single year after that, the deadline is firm, December 31st. Honestly, it's usually just simpler to take that first one on time. All right, we spent enough time talking about just following the rules. How about we get proactive? Let's talk about some strategies and how you can actually use certain annuities to your advantage to manage your RMDs and maybe even lower your tax bill. So let me introduce you to a really powerful tool. It's called a QLIC annuity. That stands for Qualified Longevity Annuity Contract. Now, this isn't just any annuity. It's a special type that was pretty much designed by the IRS for one main reason: to help people like you strategically deal with their RMDs. So here's how the strategy works. You can take a chunk of your IRA money, up to a lifetime max of $210,000 as of 2025, and move it into a QLAC. The second you do that, poof, that money is no longer counted in the balance that's used to calculate your yearly RMD. You're basically shielding it, letting you push off paying taxes on it until as late as age 85.
And the process is incredibly simple. Look, step 1, you move the money from your IRA into the QLAC. Step 2, that amount is immediately taken out of your IRA balance for RMD calculation purposes. And step 3, because your account balance is now smaller on paper, your required withdrawal is smaller, which very well could mean a smaller tax bill for you that year.
And hey, besides QLACs, a lot of modern annuities have other cool features built right in that make RMDs easier. For example, if you have an annuity that's already paying you a guaranteed income stream, those payments can often satisfy your RMD automatically. Plus, many companies will let you pull out your RMD amount without hitting you with surrender fees, which just makes everything simpler. Okay, let's bring it all home. We've gone over the rules, we've looked at the strategies, but what does all this actually mean for you and your own personal retirement plan? So, who really needs to be thinking about an RMD strategy? Well, as you can see here, it's a huge deal for folks who have saved up a lot of money in their tax-deferred accounts. It's also super important for anyone who's trying to carefully manage their income to stay in a lower tax bracket in retirement. Really, it's for anyone who wants to take back some control over their income and their taxes. Look, if you walk away from this explainer remembering only one thing, please let it be this. Qualified means pre-tax money, and that means RMDs. Non-qualified means after-tax money, and that means no RMDs. It all comes down to the source of the money. It truly is that simple.
And that brings us to the final and most important question of all. Is your retirement plan actually optimized for RMDs? Are you just letting them happen to you each year, or do you have a real proactive plan to manage them? Answering that question right now could save you a ton of money and a whole lot of stress later on. And you know what? If you're not sure what the answer is, that's okay. That's what we're here for. If you want to take a look at your own plan, or maybe see if a strategy like a QLAC could be a good fit for you, we'd love to chat. Here at The Annuity Expert, our services for annuity and retirement planning are always free. Give us a call at 770-755-1565, or you can find us online at annuityexpertadvice.com. Thanks so much for tuning in.